Welcome to the latest edition of our virtual investor video series. I'm Susanne Matern, Head of European Structured Finance, and today I'm joined by Daniel York, Senior Director on our EMEA CMBS team. We are discussing the outlook for CMBS in light of a rising rate environment and structural changes that challenge the sector. So welcome, Daniel.
Thank you.
Let's start with the key risks. So what are the key risks challenging the EMEA CMBS sector, or commercial real estate sector?
Well, tightening financial conditions and weakening occupational demand drivers really still characterize the commercial property sector. Global monetary policy tightening in 2022 has resulted in sharp falls in prime commercial property values, and that was particularly acute in continental Europe, where office and industrial yields, for example, had reached ultra-low levels.
So how has the rising rate environment specifically affected the different core sectors you look at? And are there any other risks that are emerging?
Well, obviously the rising rates resulted in a very sharp increase in yields, but there are ongoing shifts in demand, for example, from e-commerce and hybrid working, which have meant that sectors have been affected in a mixed way, really. For example, the industrial sector has begun to stabilize. There's been strong rental growth supporting that, despite yield increases. That's really been from demand for local storage and supply chain infrastructure, which was initially boosted by the pandemic disruptions, but also the growth of e-commerce. It's now being further supported by the on- or nearshoring manufacturing trend. The supply of urban industrial, so last mile assets, is really facing a surging demand. And not only that, it's facing a high competition from alternative users such as residential.
So it's an improving story for the logistics sector, but it's quite a different picture for the other core sectors like office and retail, right?
It is. Retail is suffering from continuing falling values. This is really going to continue until the danger of the oversupply has been resolved. That's really been driven by years of falling high street sales, and the rationalization process to try and fix that, which is going to hinge on local factors, is going to continue to drive ongoing redevelopment into other asset types. In the meantime, leases are being highly negotiated, and there are bespoke flexible arrangements such as turnover leases and short tenors. And this really is weakening future income security. And that, along with, particularly in the UK, danger of CVAs and the vacancy that we're seeing and rising operating costs, really is going to damage investor sentiment.
And what about office?
Well, office not only has suffered from increased financing costs, but there are three probably bigger hurdles that are going to dominate the sector in the next few years. Those are climate change, the changing behaviour of occupiers and employees, so hybrid working, and also from the changing technology that we're seeing. We're expecting a bifurcation, effectively, of the prime absolute best properties, which are green, high spec, near transport hubs, and those are going to benefit from a green premium. They'll also benefit from the hybrid working, we think. And then there's going to be the dated assets in less salubrious locations, which are really going to struggle because fewer occupiers wanting to accommodate brown properties, basically. There is also a risk on those properties from rising in costs of refurbishment. And that refurbishment, really, if it's not done, then those assets could well risk becoming stranded.
And how have these different trends affected your portfolio? Have you taken any recent rating actions?
We have. The Arrow transaction, which is backed by industrial properties, has recently been upgraded, mainly because of strong growth on the rental growth in the portfolio. The Canary Wharf transaction, that was downgraded because we had concerns that we're really reflecting our view that a number of the properties are going to need some material investment to maintain their competitiveness. And then finally, we had the Italian transactions, which are backed by retail properties, and really it's just weakening occupational demand that's this problem there.
Thanks for your insights, Daniel, and thank you for joining us. For more information about EMEA CMBS, please visit us at fitchratings.com. And if you have any questions on the topics we discussed, please send an email to the address on the screen.